Good morning or afternoon, wherever you are in the United States. Hi, my name's Ron Feldman. I am the Chief Development Officer for ApplePie Capital, and I'm hoping to spend the next 45 minutes or so with you talking about how to accelerate your franchise business growth. We're going to cover financial and operational strategies, as well as ways to access capital and best ways to leverage ApplePie in the process. A couple of maintenance and housekeeping things. There is a chat feature for you to ask questions. So in your screen, you'll see attendee chat. If you have questions, just type in that chat room and I will try to answer the questions in real time. I do have some of your questions that you asked in the registration process, and I also apologize for the little glitch we had where there was some kind of a software blip with the webinar provider on the registration questions. But I have those questions, and I will try and attend to those questions at the appropriate time during the presentation. So with that, we're going to get going. And here we go. This is the agenda for the day. Basically self-explanatory, and we'll dive right in. First things you want to look at when you're looking to grow your business is to first have alignment between your financial and operational competencies, that and your growth plan. You might have the money, but you might not have the infrastructure. You might have the infrastructure, but you might not have the money. And your growth plan or your development schedule, if you have one of those, might not coincide or align with those things. You want to have alignment because you don't want to grow too slow and you don't want to grow too fast. Using leverage, using debt where it serves you best to meet your goals, not necessarily what's available at the time. We'll get into that in much more detail later. Choosing the debt that you're going to take based on your growth plan, not the lowest interest rate. We'll talk about that as well. Knowing when to pause your growth to get your house in order. If you're not performing and you think you can grow yourself out of mediocrity or out of being below average, it generally doesn't happen. Very rarely happens. You want to make sure that your house is in order before you continue to grow. And in some brands out there, they won't allow you to grow unless you're hitting certain operational benchmarks. Out of the people on the call, a big percentage of you have one unit or are just starting. Didn't do a percentage, but it's almost 60% are less than 2 units. These are the things that we've seen over the years, and I've been doing this a long time. Many of you might be familiar with me from my old company before I joined ApplePie. I've seen all the mistakes, and what I'm trying to help you with today is to not have you make those mistakes that we've seen. First thing is, if you've not yet opened a unit, you've probably only ever tried to apply for a car loan and a mortgage. This is a completely different process. It requires a completely different loan package, and it's based as much on the brand as it is on you. So you want to make sure that you have the right person helping you in that process, or the right company helping you in that process. Many of you use too much cash or use your home equity just to get the first unit open. That might or might not be the right decision. Again, you need to get the counsel of someone who can look at what your development schedule is, or how many licenses you've acquired, or what your goals are, and put together a capital plan that aligns with your goals. It doesn't make sense to use your cash on unit 1 if you want to open 3 units in 2 years, because you're not going to be able to borrow money on your second unit if you have no cash left to put down on the second unit. The FDD is a guideline. The item 7 disclosure in the FDD that shows you the investment ranges, those are just ranges. Where it is almost always wrong, or not wrong, but where the disclosure rules are wrong, is on working capital. I hear somebody's having trouble hearing me. Hopefully that's better. I'm using a headset, wired one, not a wireless one. And then last, selecting the right financing source. If you're using your 401k as your partner, that's one thing. If you are looking to open 5 units in 2 years, it's completely different than if you want to open 5 units in 5 years. So you want to make sure that the path that you're choosing aligns with your development goals. What's available to you? SBA lending is probably the most common way to get the first couple of units open. The good news is you can lever actually in some cases up to 85 or 90% of startup costs. Startup costs are defined as the whole package, including the soft costs. So it's not just the build out, it's the franchise fee, the working capital, the grand opening budget, all those things. SBA loans offer up to 10-year repayment terms, and there's both floating and fixed rates available. Fixed rates are for the stronger borrowers. Floating rates are for those that aren't quite as strong. For those brands, and it's very brand specific, where ApplePie has a core product, it's a captive product that only ApplePie has. We can offer very similar terms to the SBA with a little bit higher down payment, 7 to 10-year repayment terms. We only do fixed rate lending. And the big difference between an ApplePie loan and an SBA loan is if your loan is over $350,000, and in some cases, if it's under $350,000, the bank's going to want to lien your personal assets. In other words, they're going to put a mortgage on your house or take your securities as collateral. The ApplePie core loan does not do that. The other ways you can do it, you can use just cash, yours or someone else's. If you're using someone else's, make sure you have a written agreement that outlines exactly who gets what and when people get repaid. You don't want to do it on a handshake, especially with family. Securities-backed lines of credit are great to use. Remember that the stock market is as high as it's been in a long time. And if the stock market goes down and you've used your securities as collateral, you might get put into a margin call. And you just have to know that that could happen and be prepared for it. I've seen some tragic results of people that weren't prepared for that. The 401k rollover for business startup, ROBS is the acronym, very bad acronym, by the way, is generally used best in concert with an SBA loan. When you use a 401k rollover and use up all your money to get your first unit open, it generally doesn't have a good outcome. For those of you that have 2 to 5 units, that's about most everyone else. There's only a few with over 10 units open on the call. What we've seen is people running out of liquidity, and that goes back to my point of using up all your money on unit one. You want to make sure that you have the liquidity to use your cash as an equity injection on the second, third, fourth, and fifth units. People get lured into some of this risky financing that's out there, merchant cash advance, or some of these online lenders that are offering you very quick money with very high interest rates. You got to read the fine print. Some of them are 60 to 70% if you annualize it. And they require a 1-year payback. So if you borrow $50,000 and a 1-year payback at 20%, you're giving them back $60,000 in 1 year. What's that going to do to your cash flow? The flip side to that is people that are so conscious of interest rates and trying to get the cheapest capital that they don't look at their growth plan. The cheapest capital is always the most conservative capital. And the most conservative capital is not going to be friendly to you if you're trying to grow. So while you're in growth mode and I call it hunting mode versus farming mode, you want the capital that will grow with you, not regardless of the price, but at a reasonable price. And that's where the balance comes into place. And that's where you need to have someone on your team that understands the markets and will get you to the place that you want to be. The couple of the questions that we got up front is leveraging, I'm going to ask whoever asked the question about leveraging with a lease. If you could type into the chat what your a little bit more clarification on that. And one of the other questions I got here, which was a very good question, was, are we going to talk about a $15 minimum wage? $15 minimum wage is already there in some cities. You'll notice that the prices of the food in those cities is higher than the prices of the food in other cities. I don't know of any lenders that are underwriting to a $15 minimum wage yet. I know that should that happen, it is my estimation that prices will just go up, and it will be basically, I wouldn't say agnostic, but it shouldn't be the thing that drives profit out of running a restaurant. People understand that if workers are making more money, that they have to pay more for their product. On the last bullet here, unprofitable units, this goes back to what I said earlier. If you're not profitable now, you shouldn't grow. So you want to make sure that you are almost having too much business when you're ready to grow. Are there any partners that work with ApplePie to have advanced pricing and make the store valued more? If you could, let's talk about that offline. I'm sorry, I don't quite understand the question, so let's just save that for offline. Once you've got 2 to 5 units, here you need to start considering the limitations. And if you're in a market, in a brand that's an established brand, and there's not room for more than 5 units, and you want to have a 10-unit umbrella, you might have to get more geography, or you might have to go multi-brand. One of those two things has to be true if your market is sold out. So you want to make sure that if you want to stay in the brand that you're in, that you have enough green space within the market that you're in, or if that's taken up, that you've already done some diligence and are looking for brands that could be synergistic with the brand that you're in, so that you can lever your overhead, you can lever your infrastructure and your team. In the other issue in SBA is you could run out of borrowing power. There's a few people on this call with very high investment brands. A couple of the adventure parks and doggy daycares and swimming schools, where it's a couple $1 million to get 1 unit open. You'll run out after 2 of SBA money. So you want to make sure that you either have the financial backing to not have to use SBA money, or that you have the ability to bring in other partners. There's a lot of creative structures that you can use. Again, we can help you with all of those things once you get to those sizes. The core product that we have is really perfect. This is where we do most of our lending, quite honestly. And we have a very aggressive recapitalization. We call it recap and grow. We'll talk about that later. And then straight conventional lending. And by the way, when we talk about conventional lending, we're talking about franchise lenders that don't take outside collateral. If you're going to put your house up, or you're going to put up other assets, they're really lending you on those other assets. We're talking about lenders that lend against your business and a personal guarantee, but not taking assets as additional collateral. In this case, depending on the brand, most brands you need to have more than 5 units, and quite frankly, the brand has to have more than 300 to 500 units open for those conventional franchise lenders to be involved. In some cases, they will go as close to unit 1, they'll do unit 2, but that's very, very few brands. Once you get to 5 units, it's a bit of a different story, and we have a bunch of you here with more than 5, actually more than 10. This is where we see people leaving cash on the table. This is where you really lever the equity in your existing business to cover your growth with the development lines of credit, um, all kinds of other strategies where you can really put your foot on the gas pedal, or open a second brand, or you have a lot of options, provided you have good operations and you're not over levered in the beginning. The other thing that people have that we've seen is that they're excluding all those small costs that are so important in units 1 to 5, and they're just financing the build out. Or that they aren't thinking about the reimages and remodels on their existing units when they're going to access the capital markets to cover those costs. So there's two sides to that. You want to make sure that you're holistically, again, having either you're doing it, you have a professional that does it, or you have someone like ApplePie on your team to look, again, holistically at your operations and give you some counsel on what we think is the best strategy for you. The third thing is loan covenants, and they're in most every conventional loan. They're generally not in SBA loans, for a different reason that we won't get into. But loan covenants are something that, you get the lowest interest rate possible, and then there's a bunch of covenants, and then somehow or another you trip a covenant, and the bank, instead of calling your loan, says, well, for $10,000, we'll waive this covenant this year. And then what did your effective interest rate become? Because you're paying to untrip a tripped covenant. So you want to understand those. You need to help reading your loan agreements. It's very, very important to understand the whole covenant issue. There's also something called a post-distribution covenant. That's actually telling you what you're allowed to take out of your own business. If there's a post-distribution covenant in your loan agreement, you want to make sure that you understand exactly what that is and that you're comfortable with it. How do you do that financing? Always over 5 units. Most everything we see is either conventional or core. Not too many people are going SBA, generally because they got their house back and they're happy that they have their house back. In conventional lending, you have issues like covenants, which I talked about, and prepayment penalties. If you're looking to do anything in the next 2 to 3 years, you could have either a lockout, you could have a 4% prepayment penalty, a 3% prepayment penalty. You want to just know that stuff up front, make sure that aligns with your plan. In core, we have loans with prepayment penalties and without prepayment penalties. We have it both ways. So it really depends on what your situation is, but we generally have a product that meets your situation. And as I mentioned, SBA, you're probably not very relevant for you at this point. One of the questions that we got was consolidation of loans and collateral release. ApplePie Core is very, very relevant if you're looking to get out of SBA loans, get a fixed interest rate. If any of you out there have SBA loans, odds are you have a variable interest rate, and that rate's gone up over the past couple of years. You want to get out of that variable rate, because if we do have inflation and rates go up, then your cost of debt is going to go up. You want to get into a fixed rate. You don't want to have any interest rate risk. And if you've pledged your house, you certainly wouldn't mind getting it back so that you can use your home equity to put a new kitchen in or to pay for your kids' college tuition. So for your question, that is a definite positive of using our core product, and it's one of the most commonly used use of proceeds for us. What products are out there to accelerate your growth? First, let me talk about how we work. So you, the franchisees, are on the left side of this screen. These are the general products that we offer: core loans, SBA loans, conventional loans, and equipment loans. And then we have a lending platform. We have about 35 banks that we work with, along with our own money. So with your single application, we will score it and let you know where you qualify. We'll then have a discussion about what's best for you, and then we'll move forward with whatever products you think we all collectively think are the right thing to do. Of course, it's your decision. We're agnostic as to what product that you take. We just want to facilitate your ability to access capital and grow at the right pace. This is this is kind of a time chart of a franchisee, a life in a day, almost a decade in the life of a franchisee. So first unit, you're doing an SBA loan on pro forma. Second unit, you're doing that too. Then you open a third. So you got 3 units open. You then refinance those 3 and you buy a few more. Then you're opening a couple of more. Then you recapitalize the whole company. Now you're into the remodel. And then ultimately you have all these loans paid off, and now you have all kinds of equity in your business, and you get a DLOC, which is a development line of credit, and that helps facilitate your growth up the road. We offer all of those things. Other than straight working capital or factoring, we're getting into both of those products second half of this year, and we're excited to be launching them. This is, in a graphic form, kind of what I talked about. First thing we do is a needs analysis. We look at what your growth planning is. We do the packaging of your loan, so you don't have to. Everything we do is digital. We don't even accept anything by email. We don't want your social security number floating around anywhere. We have that counseling session, and then we go to your funding. 3 reasons why ApplePie is who they are, or are who we are, is we only do franchising. We don't lend to anything other than the franchise space. We want the lifetime relationship with you. We're not interested in a one-time transaction. We're not interested in we certainly will help you with a one-time transaction, but we want to be your partner. That's kind of what our core value is. And you don't have to be spending your time going from bank to bank trying to figure out what the best deal is. When you engage with us, you get us and all of our banks, and you have a much higher probability of getting a yes, and B, getting a better deal, because all of our banks know that we are shopping every deal. So we're very different than some of the other platforms in that we actively shop instead of just posting things and letting people, if they're interested, touch on it. Let's talk about remodels and recapitalizations. Had a couple of questions on that. First, remodels. If your unit's going to be shut down for a period of time to do a remodel, you want to make sure that you've got enough money to keep your team there in today's employment environment. You don't want anyone leaving because you're going to lay them off for a week. You want to make sure that you have enough capital to affect the remodel and any other out-of-pocket costs that you have. If you have a number of remodels to do, it might make sense for you to do a recapitalization to refinance your business to cover all of your remodels. Again, there's no right or wrong answer. There's only doing a pro and con analysis of which way to do that. If you're looking to recapitalize, there's many ways that you can. One would be to recapitalize to grow. Another might be to recapitalize to get extra working capital, perhaps pay a dividend to your shareholders. Recapitalization generally means you're refinancing your debt plus. A straight refinance is just saying, all right, I owe 100 grand, I'm going to borrow 100 grand, I'm going to refinance. Recapitalization is I owe 100 grand, but I want to borrow 200,000. That's kind of what the difference is. I get that question quite often. Then multi-unit rollouts. This is where it gets to be more art than science, especially if you're in the early stages. If you're in the early stages and you want to open 3 units in 2 years, you need to have professional advice. Don't try to do that yourself unless you have all the money. And if you have all the money, is that the best use of your money? So this is where you definitely need to get some counsel. Make sure that your development plan is in alignment with the financing that you have, and again, as I mentioned earlier, the infrastructure that you have. When you look at products side by side, this is kind of a quick checklist of where each product is applicable. The one thing that's not here is, SBA is somewhat brand agnostic, where all of the rest are not brand agnostic. If you're in a brand where, and there's a couple people I saw on the registration list in very, very young emerging brands, you're going to have a real tough time getting a conventional lender or even ApplePie to do unit one. We have certain size rules for first unit financing that we have in place, but SBA is generally available. Again, once you're in SBA, those fixed rate lenders generally want to lend to brands that have a tenure, not the very first, second, third, or fourth units. And the equipment finance side is really done for the most part. We call it equipment, but it's remodel, reimage finance is really what that is. How do we work? Until you have a location, it's kind of done in the preliminary stages. Think of it like a mortgage pre-approval for buying a home. You'll complete an inquiry form online. We'll identify what products you qualify for. We'll get you a proposal or a term sheet. And until you have a location, we really can't underwrite, or there's really no one that can underwrite a loan until you know what your rent and your fixed costs are going to be. Once that happens, we'll do the formal underwriting and close and fund. One of the big differences between the ApplePie core product and SBA lending is that when your loan closes with ApplePie, all of the money is deposited into your business checking account so that you have the money to pay your contractors. As opposed to, for those of you who have been through this process, the contractor gets a draw, and then there's a site inspection, and then there's a mechanics lien waiver, and then it just keeps going on and on during the build-out process. That's especially true, again, in these large investment build-out type brands where it's $1 million, $2 million. That process can get to be very timely and very costly. This is just some screenshots of our digital application. It's all very user-friendly. It populates a list of documents you need to upload. Once you upload it, it checks it off and takes it off your list. It's really optimized for only franchise loans, again, because that is really all that we do at ApplePie. This is the thing I had mentioned earlier. Even with one unit open, if you're in one of the approved ApplePie brands, you can use the equity in your existing operations to help finance the growth of your business. So it's a pretty simple, and the URL's there, and we just put it in the chat as well. Very simple calculator. You'll see that we look for your EBITDA, and hopefully if you're in franchising, you know what EBITDA is. Earnings before interest, tax, depreciation, and amortization is what it stands for. It is actually the license plate on my car. If anybody comes to Pennsylvania, if you see that car, you'll know it's me. We look at the last 6 months. The reason we look at the last 6 months is because in most franchise businesses, the last 6 months, unless there's seasonality, are better than the last 12 because you're growing, especially if you're in that early growth phase, or if you're in one of the fitness brands or you're in one of the membership-based brands where your fixed costs are set on day one, but your memberships catch up. So we look at the last 6 months and we annualize it. We look at how much debt you have and we tell you what your borrowing power is. That's just a subtraction of the multiple of EBITDA that we can credit you. And once you have that borrowing power in place, you can either fund the down payment on your next unit, or quite frankly, fund 100% of the next unit and leave that unit unencumbered, because ApplePie only takes liens on the units that we lend against, and then use that unit to help you grow further. So hopefully that makes sense to you. We are very proud of that product, and again, I think we're the only people in the country that offer it. Now we'll turn to any questions. If you have questions, please put them in the chat. I'm going to look back at the questions that were typed in and see if I missed any. $15 wage. Do we provide lending for upgrades or expansion? Yes, we absolutely do. It is what we do for probably 60 or 70% of our time. We're really good at that. Let's see if there's any other questions here. One of the questions was, if I get a quote from ApplePie, will the person I work with be an expert in my brand? If that brand is one of our partner brands, yes. If that brand is not one of our partner brands, it'll be somebody that does nothing but franchise lending. On the slide with equipment as a financing option, yes, we do financing for refreshes, including equipment replacement. Basically, you could change that word equipment to re-image or refresh, whatever terminology you wanted to use. Absolutely. Are fees, the lending X amount as a relationship bills, can the fee be waived? The question was about fees, and the fee question, market conditions drive fees, so it's hard to predict anything in the future. We do offer reduced fees for repeating borrowers. We do have last I heard, a 38% repeat rate, and only being open for 4 years in business. That's pretty strong. So generally, when folks borrow money from us, they continue to come back to us for more money. I think that's all the questions I had on the registration form. Any other questions coming from the audience? I'll give it 15 seconds. If you do have questions after this, you can just go to our website. We'll send you out a recording of this later so that you have it. Again, that's in the chat. And I want to thank you all for your time. If you could all, before you disconnect, give us a thumbs up, a thumbs down, whatever emoji you see at the top of your screen, and please give us some feedback so that we can try and improve this type of programming in the future. So thank you all, and have a great day.